Welcome to Real Estate 360, an informative and engaging hour discussing everything you need to know about the world of real estate. Your host, Tom K. Wilson, provides you with insight and guidance from his years of experience as a successful real estate entrepreneur on how to buy, sell, finance, and invest in real estate, and much more. Now, here's your host for Real Estate 360, Tom K. Wilson.
Welcome back. Nice to have you with us today on a new program. Thanks for tuning in to our Real Estate 360 program, your number one source for all of your real estate needs and education. We're broadcasting from the number one business radio station in the San Francisco Bay Area, KDOW AM 1220, the Wall Street Business Network. I'm Tom Wilson, your host for the Wednesday edition of Real Estate 360. That comes to you daily Monday through Friday at 3 p.m. and also on Wednesday and Thursday at 2 p.m. along with my co-host Joe Kuchera and Laurie Graymont. If you can't make the live show, you can catch our podcast on RE360radio.com, and you can catch my programs on TomWilsonProperties.com or on iTunes. If you go to TomWilsonProperties.com, you can get also an economics newsletter that's a short read, economics as it applies to real estate. And within a couple of minute read, you can catch up on all the things that are going on that affect your real estate decisions. You can also ask for a report on how to select the best metro and product for investing in the United States. And most of that applies to, much of it to international as well. And then please let us know what your questions are, and we'll be glad to respond to them individually. If you have suggestions for new topics, let us know what they are. And if you'd like some consultation on how to proceed or change and move forward with your portfolio or begin a portfolio of real estate investing, please do so, and we're glad to do that. We'd like to let you know about the KDOW Business and Money Expo that's coming up at the Santa Clara Convention Center on April 5, 2014, and it'll be from 10 to 4 p.m. Again, that's the KDOW Business and Money Expo. We'll be there, and it will be on April 5 of this year at the Santa Clara Convention Center. So we're going to, today we're going to talk about, we're going to have back our regular guest who's on with us frequently, Richard Crouch, and we going to have a great topic about how the lending laws have changed. As if you haven't heard Richard before, he's a engineer by education, a Silicon Valley entrepreneur, an investor. He's a top producer at Alain Pinel Realtors, and he's investment advisor representative for Transamerica Financial Advisors. We're going to discuss today how the lending laws are changing, and from a broad perspective, and as a agent and as a analytical person who's stays interested and self-taught in this arena, is going to give us a perspective from an agent who makes recommendations to his buyers and sellers and just follows the market closely in general. So as you may recall, the lending laws were, of course, very, very loose. The political motivations were to have everybody in a house and make loans very easy. We all know the history of what happened with that. These pulse loans resulted in too many people having loans that they couldn't handle, and we really had a credit bubble. We didn't have really a housing bubble. We really had a credit bubble. And then when things crashed, it was everyone discussed that the loans being too loose was probably a factor, and maybe they should be tightening up the requirements. Personally, I think maybe what needs to be tightened up more is the subsidy of loans and the guarantee of loans. And if we had more of a free market, it wouldn't have been as much of a problem. But at any rate, with the system that we're working within, putting some more restrictions on loans may minimize the potential for default in the future. At least that's what the politicians' objective is. And we're going to discuss today how they're changing, how that may affect you, what maybe you should do about it. And let's get into that. And Richard, welcome back to the program.
Thank you, Tom. Good to be here.
So this is on the surface, one might think, well, this could be a few word overview, and what else is there to talk about? But as it turns out, this is a very, very complex subject. It's been discussed from probably within months after the crash. We've had other things that have been, other regulations that have been instituted to try to minimize a repeat of the crash that happened, and more importantly, the run-up that was really responsible for the crash. And yet it's there's lots of different opinions, and Dodd-Frank was one of the bills. We've had other bills that have that certainly have been introduced, and we are still, it looks like there's still a lot of interpretation and both attempts at interpreting by the lenders and the general public, the general investment and lending world, as to how this is going to apply and how it's going to play out. So to start off, can you give us a little overview there, Richard, as to what your perspective is?
Yeah, sure. Let me just mention that one of the first things that the government did or wanted to fix was the big banks, and they to in effect regulate them when they had been deregulated and fine them. So we've seen the large banks, Wells Fargo, Chase, Bank of America, all paying huge fee penalties because of the problems that occurred. And so that was kind of the first knee-jerk reaction was to try and help the consumer. Something that takes longer to come about is a broad-based solution to preventing those problems from ever occurring again. And that's where Dodd-Frank really started kicking in just a little bit less than a year ago. Just in this month of January, we now know that things are indeed going to change in terms of how easy or difficult it's going to be to get a loan, and under what circumstances you can or cannot get a loan. And even though we're going to talk about very specific things here in a moment, the reality is that none of it is fully implemented yet. So it's a very kind of a loosey-goosey gray area that we are in right now when it comes to borrowing for real estate purchases and sales.
And in effect, do you mean that the law has been passed, but it hasn't been fully implemented by the lenders and banks that are supposed to, because they're still trying to figure out what it means, how to apply it, so interpret it, so forth? Yeah,
that's correct. And I think as I go through the key points of what we call a qualified mortgage, which is kind of the standard going forward, it'll be fairly apparent why, even though it was announced on January 10th, it wasn't like somebody flipped a switch and everything was changed overnight, okay?
That's a very good point.
Yeah,
so I think a lot of people feel that from the...
Yeah, all the lenders are really trying to, especially in underwriting, which is, the single most subjective aspect of lending, the fees and other such things, what ratios you can qualify for. Those are a lot easier to implement. You could do it immediately, but it's really the underwriting. So let's talk a little bit about that. A full definition of a qualified mortgage. Let me just say there's a qualified mortgage in the future, and then there's all the rest of the mortgages, okay? A qualified mortgage is one which is insurable by Fannie Mae and Freddie Mac, okay? And that's changing in a fairly dramatic way. So within Dodd-Frank, became a law on July 21, actually, of 2010. That shows you it's been 3.5 years.
In the making.
Which, there's a lot of, it's very difficult to take something through Congress and get it implemented, but better late than never, okay?
And I think most people have no idea that it was, began that long ago, and we're just now finishing
Right.
The final phases of trying to implement it.
Okay, exactly. So here are the key features of a qualified mortgage going forward, again, with a caveat that you can go to lenders right now and still get loans under the previous guidelines. But be aware that they are going to change, and they're going to change without notice. Okay? So one of the first things is eliminating excessive upfront fees and points. Fees and points, of course, additional costs charged by the lender during mortgage application, processing, and closing. The QM rule puts a limit on these additional charges, including those used to compensate mortgage brokers and loan officers. Generally speaking, the points and fees paid by the borrower must now not exceed 3% of the total amount borrowed, if the loan is to be considered a qualified mortgage, in other words, insurable.
Yep.
Okay. Certain exceptions have been made to that particular limitation for bona fide discount points on prime loans. We'll talk about that in some detail here in a few minutes. The second major topic feature of the QM loan is that there will be no toxic loan features. And in this context, toxic loan feature refers to any high-risk feature that may have contributed to the mortgage and housing collapse of 2008. Such features are prohibited by the qualified mortgage rule, such as there will be no interest-only loans. That's a big impact. I mean, almost everybody I know had interest-only loans, including myself. There will be no negative amortization loans, to say the least. In other words, negative amortization loan meaning one which, in time, as you make payments, the balance of your principal that you owe is going up, which led to a lot of the problems in the subprime. And then no terms beyond 30 years, which means that you can't get a loan for more than 30 years. You know, in Canada, it's maximum 26, and there had been rumors that they were going to cut back from 30 years back to 25 or 26. So far, that has not happened.
And a lot of places in Europe, it's even less.
Right. And then the last bullet, no balloon loans. Okay? So they will be prohibited in most cases. Some exceptions have been made. Smaller lenders in rural or underserved areas may still make such loans. And definition, by the way, a balloon mortgage is one that has a larger than normal payment at the end of the repayment term.
We're talking today about qualified mortgages, what the new regulations are, to what degree they're already implemented, and how long they're going to take, and how they might be implemented, and how it might affect you and your decisions coming up. We have Richard Crouch with us today, a regular guest who is a top producer at Alain, Pinel Realtors and a Silicon Valley entrepreneur. This is Tom Wilson, Real Estate 360. We're on KDOW 1220 AM, the Wall Street Business Network.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. We are discussing today with our in-studio guest and frequent guest, Richard Crouch, who is a engineer by education, Silicon Valley entrepreneur, investor, top producer for Alain Pinel Realty, and investment advisor representative for Transamerica Financial Advisors. And we like having Richard on because he uses his analytical background and Silicon Valley experience to help interpret from a very practical perspective what's going on in our world of real estate and from an economic standpoint. And today we're talking about the QM, or qualified mortgage regulations as they are being implemented. And Richard, let's continue on that note.
Yeah, just as a quick overview from a moment ago before the break. So QM, there are four things that are significant changes: no interest-only loans, no negative amortization loans, no terms beyond 30 years, and no balloon loans. Now, setting the stage for that, let me say that that's very restrictive, but what it boils down to for someone to qualify for such a loan, the maximum ratio of income to debt is 43%. Now, just to put that in perspective, during the wild and crazy days, the old west of lending, people would get qualified sometimes as much as 50, 52, 53%, maybe in some cases more, depending upon their total income.
And maybe for some of our listeners who are new to this business, explain what that ratio means.
Well, it means that the income monthly income that you get, the ratio of that to the total indebtedness, if you will, and under the Dodd-Frank, that is not just the mortgage payment, taxes, and insurance. It's really your overall ability to pay based on your actual balance sheet, your income statement as an individual, right? So it's going to be much more closely looked at by underwriting. And 43%, they want that other 57% to be unencumbered by debt for buying a home or getting a home loan.
Okay. Thanks.
Now, the other thing that goes hand in hand with that is a credit score, minimum credit score of 700, which is pretty liberal, really. I mean, 700 is on the borderline of not having really good credit, So they're at least making it possible for people who have good credit to qualify. Okay, as long as that ratio of 43% holds. Now, what that means is that all other loans of all shapes and sizes, okay, banks can still lend to borrowers, but the difference is that they cannot insure those loans will not be insured by a third party, which means that the banks will have to warehouse those loans. Mortgage bankers will have to lend from the pool of money that their investors give them.
Which is generally referred to as portfolio lenders.
Portfolio, exactly.
Meaning they hold those loans within their own portfolio as opposed to selling them off to a third party, which right now is dominantly Freddie and Fannie and Fannie Mae and Freddie Mac. And last time I looked recently, they were insuring about 87% of all the loans in the U.S.
Right. And let me just say that the QM mortgage, because I didn't mention this a few moments ago, that can apply to any loan of any size, including jumbo, as long as 43% and score of 700 applies. So you now have a much greater ability to have an insured loan, and that's a good thing. Okay, good for the banks, good for the country, good for you as an individual borrower. Okay, so but the part that gets a little bit more challenging is if you don't qualify for that 43%. I think, to say the least, a credit score less than 700 is going to be tough under no matter what. So having good credit is really, really important. But so the QM loans basically they can exist for that entire spectrum, okay? But all the rest of the loans have to be made with a whole different set of underwriting, and it's going to be real difficult if it's not qualified to get a loan approved.
All right, we'll continue that in a moment. When we get back from the break, we have Richard Crouch with us today, investment advisor for Transamerica Financial Advisors, top producer for Alain Pinel Realtors, helping us to understand the qualified mortgage new rules. This is Real Estate 360. Tom Wilson, your host for today's edition. We'll be right back.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360. Streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back to the program. Today we have in studio our regular guest, Richard Crouch, top producer for Alain, Pinel, Realtor, and a Silicon Valley entrepreneur and engineer by education who helps us interpret what's going on out there in the real estate world. We're talking today about qualified mortgages that they've really, since the crash, they've been implemented slowly over the past 2 or 3 years. We've had a new milestone here on January 10 from a legal standpoint, but all of the lenders and underwriters are still trying to figure out how to interpret it. But it will affect all of us, and we're trying to figure out how and when and what to do about it. Richard, let's continue the discussion there.
Yeah, so we talked about, again, January 10th is when this qualified mortgage was announced, and I said earlier that it does not mean that these requirements you're going to face these requirements immediately in underwriting, and very specifically for current loans that can be insured or were being insured, if you will. So the $417,000, for example, with Freddie Mac, Fannie, FHA, Veterans Administration loans, those loans will continue to be made with the old underwriting guidelines until some later point in 2014 with no specific date. But just mind you, if you're in the process of just getting ready to buy a house and you were counting on a $417K loan, you should be able to get it unaffected by QM in this month of January and maybe even February. But going beyond February, there's anybody's guess. Okay. Now, what I said earlier is that QM loans cover every loan of any size up to the point where, or shall I say that for someone who can qualify for a 43% income to debt ratio and has at least a 700 credit score. For loans where somebody does not meet those requirements, the banks are trying to figure out how are they going to, what their underwriting guidelines are going to be, and that's very much up in the air with the big banks, okay? And so there's two things that have been implemented, though, within the QM that give banks the ability to make some exceptions. And let me just real quickly mention those. Safe harbor and rebuttable presumption. I'm sure that second one that I just named, you're probably wondering, what the heck is that? So safe harbor of the two types of QM loans gives the lenders the highest level of legal protection. They are lower-priced loans with interest rates closer to the prime rate. They are typically granted to consumers with good credit histories, less risk. If the borrower ends up in default foreclosure down the road, the lender would be considered to have legally satisfied the ability to pay rule. Thus, it would be harder for the borrower to sue the lender in court. However, borrowers can still challenge their lenders in court if they feel the loan falls short of the QM parameters outlined above. In the next segment, we'll talk about rebuttable presumption. You might want to look it up in your dictionary before we return.
or maybe not. No? We're discussing the qualified mortgage changes and the new Dodd-Frank laws and their implementation with Richard Crouch, our regular guest here at KDOW at Real Estate 360, and it's great having Richard with us because he gives us his technical entrepreneur background perspective on what's going on in this real estate world. This is Tom Wilson with Real Estate 360. We're on KDOW 1220 AM, the Wall Street Business Network, and we'll be right back and to help finish interpreting what's going on with Dodd-Frank, etc.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. Richard Crouch is our in-studio guest today and regular guest to help us interpret what's going on with the changes in our world of real estate. We're talking today about the qualified mortgage and the changes that go on in it, how it will affect you, what your timing is, and so forth. Richard, you want to talk about you were going through some of the factors there that
Yeah, let me, for those people who may have just tuned in fact, I just want to summarize really quick that a qualified mortgage, in order to qualify for it in the future, and it officially became part of the law on January 10th, but is by no means been implemented broad-based by any banks at this time. But the objective is that there would be no excessive points and fees. 3% of the total amount borrowed would be the maximum. That there would be no toxic loan features, no interest-only loans, no negative amortization loans, no terms beyond 30 years, and no balloon loans, okay? And then we mentioned that the qualifications are 43% debt-to-income ratio maximum and a 700-plus credit score. So with those parameters, you can get a qualified mortgage, and it can be for any size of loan that the lender is willing to lend and fit these guidelines, okay?
Now, I might add that recently here, Wilson Investment Properties, my business, had a home that we were selling in Silicon Valley, and it was a $2 million house, and the buyer came along wanting to buy it with cash, but they didn't have the cash right away, and they it's going to take them 3 or 4 months to come up with it, and they wanted seller carry. So we studied a bit how these new terms, with new qualified mortgage regulations might affect it, and it turns out it affects the seller carry loan as well. So if that's something you're considering on either side, take that into account too, because again, they don't want you to have a balloon loan. They want you to do a fully amortized loan, so that affects your monthly payments and so forth. So in this case, a 90-day short-term loan. Well, if you fully amortize that, you got to come up with a third of $2 million on each of those 3 months. So that doesn't quite solve that problem. So it's always we always wind up with some unintended consequences. And on the surface, yes, it's clear that pulse loans were not a good idea, but we'll see if the pendulum has swung too far the other way, and some of these regulations are too tight. But regardless, you need to know what they are, and that's what the rules of the game are, and we've got to work with it. We've got to understand how to work with it.
You bet. So the other thing that I wanted to mention once again is that there is a temporary exception under Dodd-Frank for loans that are eligible to be sold or insured by Freddie Mac, Fannie Mae, FHA, or VA. So if you're going to be getting a loan in the next month or two, you're probably not going to be impacted by Dodd-Frank, but I wouldn't want to predict anything beyond that. And then the next thing we talked about previously is certain protections for lenders, ones where they could make an exception to the 43% 700 rule, but if they did, the lender could be actually considered to have legally satisfied the ability to repay rule, and it would be harder, therefore, for the borrower to sue the lender. So there's some wiggle room there in certain circumstances. The other...
And I might add that in the past, exceptions were the norm.
Yeah.
And now it sounds like there's still some room for it, but it's going to be a lot more restricted.
Yes. The other category which helps the banks to try and be a little more flexible are called rebuttable presumption. These are higher price loans that are typically granted to borrowers with lower credit scores. In this context, higher priced refers to a loan with interest rate that is more than 1.5% higher than the current prime rate. Lenders who grant these types of mortgages will receive a type of legal protection known as rebuttable presumption, which offers less protection than the safe harbor that we just explained. If the borrower ends up in a foreclosure situation, he or she could still win an ability to repay lawsuit if they can prove the creditor did not consider their living expenses after their mortgage and other debts. So again, wiggle room, protecting the banks a little bit, protecting the consumer a little bit, and hopefully somehow all that will come into equilibrium as this thing goes forward. So regardless of these two protection clauses, by the way, consumers can still challenge legally their lenders for breaking other federal consumer protection laws. Okay. So given all this, let me just real quickly mention, those of you wanting to buy, what's the penalty for delaying? Which I think right now is a time when if you do delay right now, you're going to pay a penalty because the markets are going to improve over the months ahead. And then Dodd-Frank is going to be more implemented as time goes by and with much more restrictive underwriting. So looking for November 2012 to November 2013, the average price of a mortgage, this is in the U.S., or the home, I should say, is $227,900 and 200 with an interest rate of 3.32%, principal and interest $1,000.61. And I'll backtrack a moment. That's actually the loan amount, okay? In November of 2013, that $227,900 went up to $244,500. The interest rate up from 3.32 to 4.29%. The principal and interest monthly payment $1,208.53, which means in that year, if you did not buy, it's going to cost you $207.92 more per month, and that's an average in the U.S. Here in the Bay Area, that number is much bigger.
Things are crashing. It's a different story. Things are going back up now, and the longer you wait, the weaker your opportunity might be, both on buy side and on sell side. We have Richard Crouch in the studio today, helping us to interpret the new qualified mortgage rules. This is Tom Wilson with Real Estate 360 on KDOW 1220 AM, the Wall Street Business Network. Stick with us. We'll do some recap for you.
For more information on today's program, visit RE360radio.com. That's RE360radio.com. Welcome back to Real Estate 360, streaming live on iHeart, TuneIn, and KDOW.biz. For more information on today's topic or guest, just visit RE360radio.com. That's RE360radio.com. Again, your host for today's edition of RE360 Radio, Tom K. Wilson.
Welcome back. Have Richard Crouch in our office, into our studio today, who's a frequent guest for us. I want to remind you first that the KDOW Business and Money Expo is going to be on April 5 at the Santa Clara Convention Center. One location, one day. We will be there, Real Estate 360, and Wilson Investment Properties will be there to answer your questions and chat with you. So please put that on your calendar. April 5 will be a great event. Also, remember that if you go to TomWilsonProperties.com, you can ask for a report on how to select the best metro and the best product. You can also sign up for a newsletter on the economics of real estate, how what's going on in the last couple of weeks, a short read to help summarize things for you. And if you'd like a consultation by Wilson Investment Properties and yours truly on how to proceed and improve your real estate portfolio for investment, we'd be glad to do that for you. Richard, how can folks get hold of you, by the way?
The best thing is to call me, 408-391-1231.
Okay, and again, Richard is he's with top producer with Alain Pinel Realtors, and he's also an investment advisor representative for Transamerica Financial Advisors, and he is a very objective and analytical person. They'll give you a good, very good advice. Want to do a little wrap up here on any last comments about qualified mortgages and
Yeah, I wanted to just add the fact that we didn't say too much about sellers when it came to qualified mortgages, and this is something that buyers need to factor into their own decisions. That is, inventory is tight right now. Sellers know that interest rates are going up, and we've got the busiest time of any market in the spring coming rapidly, now that the Super Bowl is almost over with. And so basically, it's really important to buyers to understand that in addition to the uncertainty of the underwriting for a qualified mortgage, the prices are going to be higher over the next, they're going to go up, they're going to continue to go up over the next few months. So don't delay. There will be more inventory, but you should be out there looking right now. So when you see something that is good for you, go get it. Otherwise, you're going to have a huge competition pool to compete with, just like last year.
Mm-hmm. And so both buyers and sellers, timing is such that you may be in a better position now than you will be in a few months if you're considering making a move.
Yeah, the sellers have been holding back because of the improving economy. I think this is going to, in addition to the fact that the spring market is the strongest each year typically, that these reasons are also going to force them to put more homes up for sale before buyers get short-circuited by the title regulations.
And one more time, Richard, your phone number?
408-391-1231.
It's always great having you on the program.
Thank you, Tom.
Has helped for you to give us a little background here on what's happened with this complicated qualified mortgage new rules and implementation. Nobody has fully figured it out yet. Watch it carefully, but don't spend too much time if you're a potential buyer or seller. This is Tom Wilson with Real Estate 360. Thanks for being with us today. This is KDOW, 1220 AM, the Wall Street Business Network. And remember, the only thing that matters is what you do next. Look forward to having you back on the next program.
You've been listening to Real Estate 360 on AM 1220 KDOW. For more information on today's program, visit RE360radio.com. That's RE360radio.com. AM 1220 KDOW.